All right, welcome back, everybody. Money Mondays here with your hosts, Ben Suttles, Ferris Musa from
the Disrupt Equity Studios.
Did I throw you for a loop on that?
No, I'm always ready. Come on, man. You can throw anything at me. I'm ready for just about everything.
Did you get your coffee, by the way?
I did get my coffee. I already finished my coffee.
You already finished the coffee that I got you?
Yeah.
Oh, wow. Okay.
Should have gotten me two more, but we'll call it.
All right.
I'm always ready, all right? For
so what are we doing today, man? What are we doing today?
Death by 1,000 paper cuts. Oh, wait, sorry.
That's Mondays.
We're talking about me.
This is the funnest part of our day.
It is, especially on Mondays. Mondays like boom, 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 boom. Maybe I see Ben for about a minute during the day beforehand, and then
what are you talking about? We prep for this show for like 45 minutes prior to this thing, right, Shanna?
But we're talking about how to know if you're overpaying for multifamily property in 2022. We have a very good pulse on the market.
Why is that?
A lot of deals.
How many deals do we look at?
Tons of deals. 900 deals this quarter. Basically 830 deals, I think, this quarter.
Only 830?
We talked to a lot of brokers and we worked through a lot of things, and ultimately, in
different markets too, right? I think the one thing that's kind of unique, with our shop is that we're not just fixated just necessarily on Texas. We're looking at a lot of those deals are in Florida, a lot of them are in Georgia, some of them are even elsewhere, the Carolinas, Tennessee, Ohio. So we've got a nice pulse on where pricing is, where cap rates are going in, and which markets are a little bit more pricey than others, right? But all right, so we got some questions that came in ahead of the show, so we're going to get right into this. But if you guys do have questions, we like this to be interactive. We're going to do a little bit of Q&A at the end. Drop those questions in, or comments, or concerns about whatever you got, right? We'll talk real estate, being an entrepreneur, anything and everything under the sun, right? So what are some of the indicators that a property is overpriced? I'm gonna say I have one right now, but I want you to tell me what you're. Pretty quick.
There's a lot, right? I think the biggest thing is what you're alluding to, Ben, is where the rents are versus what the pricing is. And it's not necessarily where the rents are today, but where you can take them to.
Yes.
Right? Let's give you the benefit of the doubt, because theoretically, a deal that rents for $1 a month that I could immediately get $1,500 a month for, just because the previous owner decided to rent it for $1 a month, probably is worth something more than just modeling it.
Extreme example.
I like to go to the extremes, right? It helps people understand.
But I'll take one that's a little bit more realistic, right? And we've run the numbers, folks. This is not just a Ben and Ferrisism here. Like, this is what it is, right? So if somebody's wanting $200,000 a door and the rents that you can get are $750, I don't even need to underwrite the thing. Don't even need to do a quick and dirty underwriting. It's not going to pencil in, right? So there is a little bit of truth to that, that 1% rule that they always had in single family rentals, right? Where if you buy the deal for $200,000, if you can rent it for $2,000, then it's a good deal, right?
Yep.
Now obviously some things that get played into that, right? Like, how do you do the capital stack? What kind of debt do you have on it? What's your interest rate? All that stuff kind of plays into it somewhat, but it still holds somewhat true, right? So the closer, if they're trying to sell it for $200,000 a per unit, that is, on an apartment deal, if you can get close to $2,000 rents, I can already tell you it's a great deal. Just go ahead and get into it and start underwriting it, right? Versus if it's at $750, it's going to be a big jump for you to try to push it $1,250 per unit, right? Nobody's pushing rents that much. So that's some of the big red flags that I'd see, right? What else are some of the ones that you would say?
I think ultimately, actually the big one, I'll say this, it's value add and understanding value add. Right now, as lately, a lot of deals that we see, they've already factored in the value add component. So they priced it accordingly. They're saying, look, you can get these rents that are, maybe it's $1,500 today. I want to sell it to you for, let's say, $200,000 a unit, right? Maybe that's the spread where it makes sense. And I'm telling you, Ben, you can get $1,800 rents. Great, the $300 spread there I can get. But the problem is the price that I'm selling it to you at already is assuming I did all that work, right? It's overpriced. Versus you got to be able to buy it at a discount, because I'm going to spend the money, the effort, the time to get the units improved, to get the CapEx in. I think that's a huge one.
You're buying on pro forma versus actuals, right? And when I first got in the business, and when Ferris first started the business, there was a little bit of a shift, right? It used to be based on actuals. Now, probably the last 5 to 7 years has been based on pro forma, folks. So that rubs certain people the wrong way, but that's the difference between the people that are doing deals and the people that aren't, right? And people are saying, oh, you're being too aggressive thinking that way. And I'm just saying that is where the market has been for quite some time. And those are the folks that are getting deals done, right? So you have to take some of that into consideration, right? And you just have to say, hey, their assumptions on the value add are BS, right? They're too aggressive. And then you put your own assumptions in. But in the end of the day, right, things are priced priced where they're at because they're making the assumption that, this is the value that you're going to get to fairly quickly because we've already proven it out with 10 leases or 15 leases.
My favorite one is where they show you a comp of another deal nearby that has that all done, but they're trying to sell it to you for the same price, what it's valued. It doesn't make sense, folks. So that's a big one. I think obviously understanding cap rates, right? Yeah. And I like to say price per pound, and that means two things: price per square foot and going in caps, right? You want to feel like you're getting a deal relative to that market. Yeah. Maybe I'm buying a deal in downtown New York and it's a 2 cap, right? That's fine, but if I'm getting it for a 2.3 cap, I might be getting a deal, right? Now, can I get good returns? That's a different thing. That's in the eye of the beholder. Yeah. But ultimately, I'm big on feeling like you're getting a deal relative to the market conditions at that point in time. Yeah. Right? If you're always getting it a little bit at a discount, well, you're helping make your job easier whenever you try to complete your business plan. Yeah, and then I think cap rates are different per market, so you have to determine what that is. And really, the brokers, the mortgage brokers, the lenders can help you kind of dial that in, right? You don't want to be obnoxious about it. You want to constantly be asking them questions about it. But if you're keeping your thumb on the market like we do and underwriting a lot of deals, you're going to start seeing trends, right? So a Class A deal might trade at, call it a 3.75 cap here in Houston, but in Dallas, it's probably, or maybe specifically probably in Austin, it's probably more like a 2.75 cap, right, on a Class A deal, right? You start kind of understanding that the more deals that you're looking at, and so I can kind of determine if all things created equal, it's stabilized, it's not necessarily some kind of a distressed type situation. I could say, okay, hey, I'm paying more of a premium for an Austin deal than I am for a Houston deal. And that's just kind of what it is, right? Austin's a very high growth. Not that we love Houston too, but there's just different dynamics. Austin's also, growing leaps and bounds too, right? There's all kinds of great information about it. So, that's the reason why it's priced the way it is. It's more of a high appreciation market versus a cash flow market, right? So those are some of the things right off the bat. Within 5 minutes, you can say, okay, this is overpriced or it's not. Right? If you want to dig a little bit deeper, that's not a 100% rule. There could be some edge cases there. You're going to have to dig in, right? And we typically do a quick and dirty underwriting process, and then the ones that kind of pass that sniff test go into the full underwriting process, right? So, moving right along here, we got plenty of questions. Are there common mistakes you're seeing investors make in today's market when it comes to overpaying on a deal, unrealistic assumptions? I'm going to start with the unrealistic assumptions because again, I think some people in their mind, they might not be overpaying because they're the way that they structure deals is a little bit different, right? But the assumptions can be something where you're going to make a bad deal look good, right? And I'd say the first thing that I see, actually the first 2 big things that you need to be paying attention to if you're a passive investor is what is the rent growth that they're projecting? Right now, outside of the value add, everybody's coming in, they're putting a lot of money into these deals and then they're raising rents. Rents are also going up, 15, 20, 25% this year, right? But that's not going to always continue, right? If somebody's trying to underwrite 20% rent growth for the next 5 years, they're being aggressive. That's not realistic. Even with inflation being on fire, that's insane. But we're starting to see some people that are just they're not doing 20%, that might be an extreme case, but we're seeing, 10%. For the first 3 years and then 5% after that. Well, guess what? Any deal's going to look great, right? Because you're underwriting to these wild assumptions. I'd say the second thing that you need to pay attention to, because again, it can make a bad deal look really, really good, is your exit cap, right? We talk about entry caps, right? What cap rate are we buying it at? The exit cap or the reversion cap rate is what are you trying to sell it at, right? And we've talked about this. I'm not going to dive into this. We have a rule of thumb, 15, 20 basis points per year, right? Increase that we do as a shop, to try to be conservative, knowing that cap rates could potentially expand in the future. If they don't, it's gravy. That's even better for you if they don't, right? Or they stay firm, But, when you're saying, hey, I'm buying it at a 3.5 cap and I'm going to sell it in 5 years for a 3 cap, in my mind, you're being aggressive, right? Because, you'd much rather err on the side of caution and have that expansion of the cap rates so you can say, hey, at the end of the day, they stayed the same or they went a little bit lower, and so that's just the gravy that me and my investors are going to be able to share, or that you're just trying to make the deal work, so you're just artificially lowering that cap rate, because nobody really has a crystal ball. If we did, it would probably have been a lot easier, because cap rates have gone down 200 basis points or 300 basis points in some cases since I got into the business. And maybe I'll add one more that we didn't talk about. I'd say on the expense side, right? There are some standards right? Where, hey, payroll's $1,800. I know on average I can get $1,400. But if you try to deviate far from those standards, you're probably not setting yourself up
There's
for
rules of
success.
thumb, right?
Yeah, I mean, it's going to be, trimming expenses gets hard, right? It gets not incremental, exponentially hard, right? The more you try to trim. And so, dwelling on that and trying to go hyper aggressive where, hey, this deal is, first thing I do actually is look at expense ratios. All right, I know a deal in Texas, CB value add is probably 55% expense ratio. If I get sent a deal saying, hey, look, check out this awesome deal and it's 42%, my spider senses go tingling, right?
No, for sure.
So that's another one I think that's probably, again, if you're modeling that to be really low and you're justifying that higher price point, you're probably overpaying for the deal.
I see people doing that on the payroll side. Luckily we have our own management company. We can control our costs a little bit better than probably somebody that's using a third party. So payroll is sometimes something where you could trim. I'd say the other thing too that I see a lot of people do is utilities. Oh, I'm going to come in and I'm going to do low flow this and LED that, and I'm going to be able to reduce my utilities by 30%. Guess what, folks? I've done over a half a dozen Fannie Mae Green Program rehabs, millions of dollars put into these properties where I've put low flow, LED, anything and everything that you could do to reduce the usage at the property. And I'd say the most that I've ever seen is 5 to 10%. So, and that's on like maybe one of the 6 deals. Most of the time it stays flat. The only thing that you're really gonna get a little bit of return on your investment on is gonna be the low flow toilets, right? Because people are typically gonna take those shower heads off. The LEDs are gonna go out at some point and they're gonna replace them with whatever is cheapest. And everybody's gonna take those aerators off the kitchen sinks, right? Because nobody really likes that. But your tenants can't rip out the toilets. So luckily those are probably, and that's probably the one thing that takes actually the most usage is the toilet itself. So take it into consideration. One thing I'd say about toilets though, is don't go too low flow on some of these older properties. You can probably think you can.
Ben, please tell us why.
No, you can look in or you can think about why I would tell people that, right? But just be very careful, right? There is a reason why there's a little bit more gallons per flush. But all right, moving along. How do you mitigate risk in your underwriting assumptions? What are the best tips for mitigating risks? These are some pretty good questions.
These are.
Yeah.
Best tips is it's factoring in multiple things that can go wrong while also not essentially killing your deal, right? It's that balancing act.
Yeah.
So yes, I might get 6% rent growth because of inflation, but I'm on Model 3. I might get, the rent pops I'm trying to do, but I might be modeling a lower vacancy, right?
Yep.
So even if I don't get the rent pops or I don't get that, I'm, between the two, I'm at a good spot, but I'm also not just getting kind of hyper aggressive, right? That's maybe the way
I think you brought up a great point. And we've talked about this a little bit on the show. Some people that have this analysis paralysis and are just, a little bit skittish about, how things are going or how they could potentially operate the property, they end up killing all of their deals, right? So there needs to be a happy medium of, hey, I got to push the needle a little bit on this, but I'm going to be conservative and mitigate that risk over here, right? There's a balancing act because the fact of the matter is all of these things aren't going to happen at once. But let me tell you some of the examples of what people will do, right? They'll jack up their reversion cap rate, they'll jack up their physical and their economic, vacancy, and then they'll decrease the rental growth. Right? The fact of the matter is not all of those things are going to happen all at once, or even in the course of a 5 to 7 year hold, are they probably all going to happen in 1 year, if at all. But people are doing that on multiple years, and then they're wondering why they can't make any deals work. It's because you've just killed your own deal. All of these things completely sway a deal, good or bad, very easily. So you need to be very, very careful there, right? But to mitigate risk, right, and your assumptions, right, you need to be conservative on certain things. Exit cap rate is probably one of the most important ones, right? Your economic and your physical, vacancy, you need to work with your property management company on that. They're going to have a better idea. Don't take what the broker said in their OM. I'm sorry, we love our brokers, but they're going to take the most wildly optimistic, view and slam it in there like it's a science. And what I'm going to try to tell you people is you've got to take more what the property management company says, because they're going to say, hey, in that market, your physical vacancy on a stabilized property is 5%, right? And maybe you're underwriting it at 10, right? Who are you going to believe? Your gut feeling that you're trying to be conservative, or what your property management company is going to say, right? Because trust me, they're also going to try to sandbag you a little bit. They don't want to give you a wildly optimistic number that they can't hit.
True.
Right? So in most cases, they're being conservative. So that 5% is probably more like 3, and they're just giving you 5 because they want to make sure they can hit it, right? That's just what property management companies do, right? So again, mitigating risk is by doing the research, doing the analysis, talking with your team and your experts, and really getting the real world data, not your gut instinct on what this stuff is, right? So that's probably my tip for, what do you need to do? You need to be talking about to the people that are doing deals and people that are managing deals. Your mortgage broker is a great contact. We use Anton Matley at Peak Financing. I'd say the other thing too, when you're talking about mitigating risk, you need to be looking not only your property management company and what their expenses are going to be, what your debt's going to be, but you also need to be figuring out what your insurance is, right? We use Dan Kaderka over at Strategic Insurance Group, and these folks are giving us real data. They're seeing what's really happening in the market. These people are transactional. They're seeing a lot more deals and they're doing a lot more closings than we are, and they understand where the market is. You need to rely on your team members, right? All right, moving on. In this competitive market, how do you define the line on when to step up on the price? Well, I'd say right now you probably don't want to step up too much on price, right? Interest rates are moving up, right? And we've talked about this over the last few weeks, right? But there is a certain situation where, hey, you want to get into a market, you're probably going to have to be a little bit more competitive. I'm not telling you guys to increase your offers by a certain percentage point. I think that's ultimately what you feel comfortable with and what your investors are willing to accept as a return. But say you want to get into a new market, right? You're the new guy, you're the new gal. The broker doesn't know you from Adam. They don't know, if you can perform or not, right? They're going to probably expect you to pay a little bit of a premium, right? That's just how it is. Yeah.
And I'd say location. You hear that a lot. That's definitely a big one, right? And and also maybe if you're in it for the long haul, that's the other one, right? It's hard to step up on a deal and essentially overpay a little bit if you're in it for a short window, right? Your margin is smaller. But if you're in it for the next 10 years and you're betting on the city, the location, the submarket, your horizon is much further, right? But also your upside is much further. So therefore, if you're, let's say over a 10-year period, I think I can make 100% return. Well, if I overpay 5%, it's only 5% of the 100 I think I'm going to make. So it doesn't really move the needle very much, right? Or doesn't, in terms of hurting it. And so I think that's another one. And that's where we lose out on deals, right? We have some groups that are picking a deal for that location, that submarket, and they're in it for 10 years. Well, guess what? It's hard for us to beat them because we're in it for 5 to 7, right?
Yep.
And so their investors are more patient. They're willing to take less return because they're looking for the bigger upside over the long haul. So.
And I'd also say, certain shops are going to have better, equity splits. They're going to have better debt than you would, right? So take that into consideration, right? Don't let the broker, allow you to kind of compete against yourself, right? At the end of the day, these folks are where they're at because, they have probably better resources than you might, especially when you're starting off, right? So don't get into a situation where you're beating yourself up along the way. Really, the reason that these guys could make it work at that price is because their debt's cheaper than yours, right? So just be careful there, right? And I agree with Ferris, right? The most important reason why you might want to step up is that it's in an awesome location or it's in a path of progress, and for a fact that there's going to be this development that's a quarter mile away that's going to be, a $300 million development. Well, that's probably going to drive some jobs, right? And some growth in that area, right? So in that case, you might have some insider information, right, that some of the other groups might not, and then you got to step up because you want to make sure that you win that and be in that path of progress, right? All right. Moving along, how do you go about developing your operating assumptions? I think this question is probably more in line with, you got to get with your property management company. We talked about expenses here. I think that there is some rules of thumb that we use. There's a company called IREM, IREM. They're .org. They've got all kinds of information on, what payroll is in specific submarkets and across specific states and everything in between. You also need to get with your property management company too, right? They're going to know that payroll in Atlanta for a Class C property is $1,400 per unit, right? Those are the assumptions. We're not just taking this and putting our thumb in the air and saying, okay, well, we think payroll might be this, right? It's based on experience. It's based on what our property management company is telling us is on the street type assumptions, right? All right, so what are tips you have for passive investors for vetting deals and ensuring their investment is in good hands?
I'd say it's all about the operator, right?
Yeah.
Numbers are one thing, but ultimately as an operator, you like, know, and trust that essentially is looking at a deal holistically, not pigeonholing. Now, if you're a passive investor who wants to try to underwrite your own deals, great, right? We think there's a lot of work in getting educated that's required to really be able to pull that off effectively. Mm-hmm. But on the underwriting side, you want to look at the things that we talked about: exit cap, rent growth assumptions, debt assumptions, right?
Yep.
CapEx costs as well, right? doing rehabs has gone up significantly. We've learned that, right? Well, we used to spend $4,000 a rehab on a simple upgrade is now costing us $6,000, $7,000. So really being conscious of that and seeing has that essentially been shifting, right, with that operator, and are they essentially in tune with what the real world looks like?
No, for sure.
I'm trying to think of another thing too. I'd say understand risk-adjusted returns, right? What we're seeing a lot of these days.
Look that up, folks. There's a lot of information online about that.
There's a lot of deals out there that are being structured in ways that certain subset of investors are taking on a significant amount of risk. And yes, while return-wise, they may be able to model better returns, but people don't understand the risk as an LP that you're taking. So really understand that. We try to, if we don't structure our deals that way for that reason, we assume most investors don't really understand risk-adjusted return, and we want to be the ones to essentially reduce the risk for the investors. So.
Yes, and I agree with what Ferris said. Ultimately, if you're looking to be a passive investor, you need to start with the operator, right? You're backing the jockey, not the horse, folks. And I've talked about this, Ferris has talked about this multiple times on the show. It's important to vet and feel comfortable with the people that you're giving your hard-earned retirement money to. Please ask questions. Please do your due diligence on that, right? From there, we're typically looking at location, submarket related data, and do we like the story there? Is there growth there? Is there population job growth? Is there a diversified economy? And then I'm looking at the deal, right? Because if you have these two things that are just hitting, on all cylinders, they can make a bad deal good, right? But if you don't have one of those categories, or you got a bad operator, you can have a great asset in a great area and he's still gonna muck it up, or she's still gonna muck it up. So you really, at the end of the day, need to be looking at the operator and ask questions. You're allowed to ask questions. We love questions. So, that's really gonna be a way for you to kind of mitigate your risk whenever you're getting into these deals, right? Boom. Man, we got through that pretty quick.
Sure. If you have comments, questions, thoughts, please leave them. I know we're coming up on time, so we'll be quick, but we will continue to answer questions live. Let's see, Trevor, I think according to Facebook, he is our top fan.
Oh,
he said,
Mr. Trevor, thank you, sir.
You got my vote for Ernst & Young LP Entrepreneurs of the Year Award.
Thank you.
So we are finalists for that, so we're excited about that. And
where did you see? I'm curious, Trevor. Where did you see that at?
My LinkedIn.
Oh, you put it in your LinkedIn?
Wow. That, so. We're going to get it out here this week to everybody.
I was working today, not posting on social media.
Luckily, I have a team behind me that posted it, and I just realized that a little bit ago. So, otherwise, let's keep going.
All right. So, we are coming to that part of the show where we want to talk about giving back here, folks. So we want to talk about the Veterans Community Project, which we're doing in conjunction with Eric Upchurch and his group. We are trying to build tiny homes for homeless veterans. It's a great organization. Again, I'm matching dollar for dollar up to $15K for a total of $30K. And I'm probably about a third of the way there. But I'm going to get there because I'm going to stroke that check at the end of the day. But I'd love for you to participate, even if it's $5, $10, $20. This is a great cause. Let's give back to those that gave it all for us to be free and live in this great country, right? So check it out, bit.ly/donate to Homes for the Brave. Love any kind of contribution that you can give to that great organization, Veterans Community Project. Please check it out. All right, the spring BOGO sale. Oh my gosh, Shanna isn't allowing us to make any money on MFIN, but we love to see you guys out there.
We are doing is coming up in Seattle. Nice time of the year, awesome time to be out there. Definitely plan to get a hike and go see the mountains, go see the ocean, go do something fun. But most importantly, go learn about multifamily at the Multifamily Investor Network. We're excited.
Oh my gosh.
Should be a good time. Should have some good speakers, panels, content, you name it, we got it. So
we got Mr. Robert Helms. We locked him down last week. We got some more people in the queue that we're going to be talking about over the next couple of weeks, right? But we always have great panels. We got a lot of great content. But more importantly, it's all about those connections, folks. We've talked about this many a times, right? It's relationships and data and numbers. So the relationships you always have to have, and this is a great conference for that, right? We really encourage networking. We build that into the schedule, and people have always given us a lot of great feedback that we really do try to push that along, right? So check it out, mfinvestornetwork.com for your BOGO. Buy one executive ticket, get one for $150 off. Put in that coupon code SPRING, SPRING, and we'll see you there, hopefully, July 23rd in Seattle. Oh my gosh, we're getting close to closing out the Sunbelt Diversified Portfolio. Limited availability, but we'd love to have you in. These are a great 3-pack of deals that we have under contract that we're closing in the next, call it 4 to 6 weeks.
$34 million or so.
$34 million.
We're at about 28, so heading in the right direction, folks.
Yep. And we got the Open Door Capital folks, that are pushing it along as well. And their folks are very eager to be invested in this, but we wanted our investors to be a part of this as well. So check it out, the Sunbelt Diversified Portfolio, disruptequity.com/Sunbelt Portfolio. Click the link in the caption. We've got 3 deals, Austin, Daytona, Atlanta. Great locations, great submarkets, ton of high rent growth, high population growth. We love these deals, so why don't you check it out and see what you think. All right, so what's coming up next week, my friend?
Self-management versus third-party management.
Ooh,
Something we know a lot about, and
property
we can share and
management.
tell you what we think and know.
So bring all your comments, questions, concerns about property management, and we will see you next week.
Thank you.